We all interact with a lot of middle class people. I see a lot of anxieties with regard to money. They're anxious. Are they investing or are they just saving? People who are earning even 70-80 lakh rupees annually also call themselves middle class.
They are being humble, I think. 70 lakhs is a good salary. Let's say last 25 years, 30 years. In India, typically inflation has been in the range of 6 to 7%. So the cost of money has been depleting.
Balancing between extreme greed and extreme fear. If the asset allocation desired them to have 60-70% equity, are maintaining 20-30%. And on the other side, forget about equity, they're participating in crypto without understanding also.
Our parents' generation, we didn't have money. We used to have small homes. We had basic living. Those days, fixed deposit returns also used to be very, very high in double digits, 12%, 13%. But I think it was more to do with insecurity and, protecting capital rather than trying to grow the capital. It was all about saving.
What advice would you give to them? Because there is a lot of information, but that is also leading to a lot of chaos.
Don't fall victim to products which are trying to commit superlative returns.
When the market is good, we get those FOMO calls. और जब market थोड़ा correct होता है, we get panic calls. क्या करूँ? Market गिर रहा है. I think this mindset has to change. I think realigning to goal
देखो,
based.
वो change नहीं होगा. वो अच्छी बात है. आप फोन करो, ज्ञान लो, सब कुछ करो, right? But touch नहीं करना है.
If you were to advise your 25-year-old self on finance and investment,
I have this mantra which I've created over time.
Hi, welcome to Fincast, the podcast today where you learn to invest like the middle class and grow like the wealthy. We are very happy to welcome Mr. Akhil Chaturvedi. Akhil has over 2.5 decades of experience in the asset management business. He is working with Motilal Oswal Asset Management Company as the Executive Director and Chief Business Officer. He oversees the entire sales, operation, marketing, product development and also business development for the entire asset management company. He has been instrumental in playing a pivotal role and growing Motilal Oswal Asset Management Company in India. Hi Akhil, welcome to the podcast at Fincast.
Thank you so much.
Today the episode is like invest like a middle class and grow like the wealthy.
Very nice.
Okay, Akhil, we all interact with a lot of middle class people and they are aspirational, they are disciplined in saving, yet I see a lot of anxieties with regard to money. They're anxious. So the question is, are they investing or are they just saving sheer base of the previous habit?
No, so clearly I think the trends are evolving, honestly. So, there was a time maybe when we were young, our parents, those were the generations where, it was more about saving, it was more about safety, security, all of those things. But if you see the current trends with, those who are, let's say, born in 2000s, those who are in their, late teens, early 20s, I think clearly these guys are actually investing now, right? Because, the basics are kind of taken care of. So it's not about insecurity anymore. It's about getting rich. And to get rich, people understand that you need to invest and you need to invest well. The risk appetite is there. So the trend is changing according to me from saving to investing.
You see the trend is changing a little bit.
Yes.
Okay. So in fact, what we have seen today, people who are earning even 70-80 lakh rupees annually also call themselves middle class.
Yeah.
So is just more of a mindset shift or they worried still that this money is not good enough for me to match with the wealthy and I'll still be a middle class?
No, they are being humble, I think. 70 lakhs is a good salary, and if somebody calls themselves middle class, it's good to be humble. But yes, I think if you look at let's say last 25 years, 30 years, in India, typically inflation has been in the range of 6 to 7%, right? So the cost of money has been depleting. So let's say, entry salaries back in early 2000 or 1990s would have been, let's say, 1 lakh rupee or 2 lakh rupee. Those were the entry level salaries, right? Today, the entry salaries are like 10 lakhs, 12 lakhs, 13 lakh rupees. Education is better. People are more skilled. Therefore, as a normal inflation, if you see the wage inflation has also gone up. Therefore, I would say that it's not middle class per se, 70 lakh kind of a salary. But yeah, I think I think it's somewhere between rich and middle class.
That benchmark is
Yes,
going up also.
yes, yes.
Great. So I think when you look at a lot of those people, so I see the investment pattern of what you say is that they are investing aggressively also. I've seen that the Gen Z audience, okay, maybe people in the 25 and 30, 35 bracket, the investment pattern may be more aggressive. Okay, they even choose the crypto of the world. But when you look at people who are again the middle class and in 45, 50 also, they are concerned about safety.
Yes.
Okay, they still feel that this is hard-earned money and it should not be losing to chance.
Yes.
So they're on extreme uh, end of the spectrum.
Yeah.
So how do you think a normal person should really evaluate this kind of a situation? Because balancing between extreme greed and extreme fear, because uh, people who are extreme fearful, if the asset allocation desired them to have 60-70% equity or 50-60% equity, are maintaining 20-30%.
Correct.
And on the other side, these guys are forget about equity, they're participating in crypto without understanding also.
Yeah.
How do you think the Indian middle class should balance this fight between fear and greed?
So, like I said, Tanveer, that our generation or our parents' generation, and back then, we didn't have money, right? We used to have small homes. Maybe we didn't have homes. We had basic living. Our country itself was very poor country, right? So, in that kind of era, obviously it was all about, somehow you live through properly, you can have some money, whatever money you have, need to keep it safe. Those days fixed deposit returns also used to be very, very high in double digits, 12%, 13%. But I think it was more to do with insecurity and protecting capital rather than trying to grow the capital. It was all about savings, right? This time around, what's happened over the last couple of decades is that, as the country has progressed, most of us have done well. So the basics are taken care of, right? So let's say our generation compared to our parents' generation, we've built our homes, we have good savings, most of the stuff is kind of taken care of. So our kids don't have to really worry about the basics today. Right. So they don't have to buy a home. They don't have to think that first I have to work and then buy a home, then I have to buy a car and I have to take care of my kids and all this stuff. Those kind of insecurities our kids don't have. Right. And they have some amount of capital available. Whatever they earn is basically all free cash. Right. And when you have free cash and what they're looking around is obviously the Gen Z, they're looking at, people are making a lot of money, equities is doing very well, new asset classes are coming up. They're more aware because of social media, digital media. They know what's happening in US, they know what's happening in Europe, they understand geopolitics. So the intelligence level or IQ of the current generation versus our generation, I think there's a huge gap. Right. True. So our generation, we can say those who are, in the 40s and the 50s, we still have some, baggage of the old conservative thought process. I mean, till date, probably I'm also a little bit insecure, although I invest very aggressively, but that insecurity is always there in the mind. And when I see my kid, obviously I don't see that. They are more open, they are more keen to take risk, they understand, and they're very aspirational, right? So they are ready to experiment, and but people like us, obviously, it's how you are, how the culturally we have built up. That's what is flowing inside.
So what would your advice be to that people of balancing? I mean, to the guy who's very greedy, how do you balance? To guy who's very fearful, what will you be advising?
So I can give you a practical example. I'm sure you would have done that, and many others would have done that. So fortunately, I got into working into mutual funds 25 years back, right? So I've been in this industry for a long while. Now, I got my parents to change their investing habit from pure fixed income, recurring deposit, buying gold, jewelry, all of those things, to now my mom is 100% equity. She does SIPs. In fact, she's invested in PMS and AIF also, right? The asset allocation is completely, changed in favor of equities, right? So yeah, I think it's changing. Even the older generation is kind of more aware. They are more read, and we have great, media, news, print. So much of information, knowledge is coming, especially after the digital revolution. With all these, social media channels coming up, YouTube, these kind of sessions, what we are doing, and it is all reflecting into numbers. When you look at performance chart from equity mutual funds, these kind of products, it looks very good. So I think these people also in the older generation are also putting some money, 20, 30, 40, 50% into equities, doing through SIPs, and it's better that way at that age. Post 40s or post 50s, it's better to have a balanced approach between equity and cash, because your number of years to work starts to reduce, and the retirement gets closer, right? So obviously your equity should be balanced, but you should have, for sure.
Great, good. So in fact, you raised a question on social media and digital awareness becoming more. So I know there is a lot of awareness and people are far more informed than they were earlier, but it is leading to a lot of chaos also. We've had issues on a lot of fin influencers also.
Yeah.
Okay, where people lost money because of that. So what advice would you give to them? Because there is a lot of information, but that is also leading to a lot of chaos.
Absolutely. No, you're very, very right. And I would just suggest that don't fall victim to products which are trying to commit superlative returns. Some products with or influencers talking about some huge returns to come from some certain stocks, or certain structured ideas, whatever that may be. Usually people fall prey to greed, right? And you need to balance between greed and fear, right? Have normalized expectations and have right advisors, to guide you for any asset allocation you are trying to do. I think the first step anybody should do is have a very good advisor. If not two, at least have one, right? So they will take you through, but hear everything, but think 10 times before what you decide to do, especially when somebody is trying to offer you something which is looking too good to be true kind of stuff, right? Just follow the basics and have a very good, trusted advisor always close to you.
In fact, one of my friend, and he's also a client of ours, friend, the other day WhatsApped me saying, this guy is promising me 3% return per month guaranteed. I told him exactly the same thing, that Warren Buffett does not have that kind of return.
Yeah, yes.
Okay. And if that is so easy, then the Indian market has a lot of educated fund managers. There are a lot of IITians. There are a lot of from IIM, the World Chartered Accountant, CFA.
Yes.
They should have been very easily generating that
Absolutely.
return. Okay.
In fact, I would say in a simple asset class like equities also, just a few years back, stock markets were doing very well and investors made a lot of money, especially post-COVID between 2021 and 24. It was like a boom which was, so people made a lot of money. Now, the expectations was that we have to make the starting point of return should be 30-35%.
No, this is exactly one of my worry, because what has happened over the last 8-10 years, the way equity market has delivered, except for the drop during COVID.
Yes.
People are equating ki, equity market is like a fixed deposit.
Yes.
For a period, they'll deliver return. Yes, we are bullish.
Yes.
But you cannot undo the risk that it comes with.
Absolutely.
And my challenge today is that they have not seen a bear cycle that we have seen. They have not seen 2000 to 2003 when the market was completely drifting one way downward.
And 2008 to 2013. Absolutely no returns.
Oh, correct. So the question is, you will have those kind of scenario. So equity market has its own set of risk. It cannot be equated like a fixed deposit return. And people should invest over a long-term period. So my question to here is, do you see this change happening? Because Indian as an audience are used to buying financial product. And it's all in an ad hoc manner. Okay. Whether the goal is 2 years, 3 years, 5 years, or 10 years, they keep buying ad hoc products. Okay.
Yeah.
So Do you see is there a change happening in terms of allocating a goal to a particular product, or is it still the same?
No, so you're right. I think still this trend of buying anything, anywhere is still prevalent, right? The good thing is that there are a lot of discussions now happening around this subject. A lot of people like you in the advisory community are talking about that less is more, focus on few ideas, few products, and have disciplined way of investing rather than having a ad hoc way of investing. Because if you're going to invest on an ad hoc basis, your results also will be ad hoc. And if you invest in a disciplined way, the returns will be much more linear, much more secular, less volatile, more predictable, right?
True.
So again, I think the best way to investing is to actually plan your investing. There's something called, what we talk about, process to performance. So if you want performance, you need to have a great process.
Fantastic. Very beautiful.
And the process for investing is basically financial planning. And what financial planning talks about is that you invest for goals. You may have goals for next 1 year. You may have goals for 5 years. Let's say you may have a vacation next 1 year and you want to save ₹1,00,000. So you will invest in a certain way for that vacation. You may have a goal to buy a car next 3 years. So you will invest in a certain way, in a certain mix of asset allocation for getting to that goal. On a 5-year basis, you want to buy a home and you want to create a corpus for the 20%, 30% initial seed capital, right? So there will be a financial planning for that. Then for your children's education, then for the marriage, and then the most important goal for all of us, which nobody thinks about, is what happens after you retire, what happens after you don't have monthly income, right? So you need to put your goals in place, and then you create a process of asset allocation for all the goals that you have thought about, and then you just simply execute it, right? So planning, I would say planning is 99%, 1% is execution.
Correct. But a lot of people plan and execute, but we have seen still that there is inconsistency at times in continuing that with the plan.
Absolutely.
Your conviction gets shaken when the market is bad and all.
Yes.
So what would you advise to those people who start? It's like starting on a diet or starting on a gym routine and you fail after a few months.
Yeah.
So what would your advice to those kind of audiences?
It's a lot to do with mental conditioning. It's a typical human behavior. It's not specific to India or Indian people. It is
across the world.
Across the world. It's a typical human behavior that till everything is good, thing is good, right? The moment something doesn't go well, then you start to react. We talk about being more proactive than reactive. Right? So when you're proactive, you will have a certain way of thinking. And if you're in a reactive mode, you will keep reacting to, let's say the markets fall down, you change your financial plan. Or markets suddenly go up, then you try to change your asset allocation mix. Every time you are reacting, you don't need to do that. Because the starting point was that we have decided the goals, we have decided the allocation, irrespective in between whatever happens. There may be a COVID, there may be a financial crisis, there may be wars, whatever, just stick to the plan, right? So a lot of conditioning has to be done within the mind. And I think one of the most crucial behavior, which is slightly negative, is that before investing, we think of exiting. Right? So don't invest with the thought that you have to exit.
True.
Invest and pray to God that you never have to exit. And then the power of compounding and that long-term thinking. And I mean, it's like, when you buy gold, let's say typically our in our households, our wives and our sisters and mothers, they all buy gold. They are not thinking of selling before buying, right? Irrespective, gold does well or it doesn't do well.
True.
If you buy a home for yourself where you stay, you are not thinking that after 5 years I will sell it, right? But when it comes to equities or liquid investments, the first thing is that when will I sell it? When do I do my profit booking? When do I cut my losses, right? So it has to be seen just like as a instrument such as fixed deposit or a gold or a real estate. It is forever.
Very true.
So that long-term thought, and for that you need, again, like I said, you need coaches, or you need behavior coaches. You need advisors, distributors who will guide you through all these ups and
we
downs.
do help a lot of people, but a lot of people who do not have quality advice. So what are the kind of self-talk question you would advise them to do in those moments of doubt?
See, at that point of time, just close your eyes and think about, why did you invest, and come back to goals. Okay, I put this money, let's say I have 10 lakh rupees, and for some reason 10 lakh is 9 lakh rupee, and we are getting this itch of, what to do, get out. At that time, you have to think that, okay, this 10 lakh rupee was for my retirement, which is 20 years away. And after 20 years, everything is good, it will be good. So just forget, mentally you're just conditioning that I don't need the money, then why do I think about this, whether it is all on paper, right? These are notional gains, notional losses, till the time you actually book your loss or your gains, right? So mentally, in the mind, you have to just keep thinking that what was the starting point of your investment? Why did you do the investment? What was the purpose? What was the goal? And if that goal has not come, then you don't need to react. And one thing which people can do is stop watching TV, at least in bad times, right? TV, computer,
cut the noise.
And advisors also should not send portfolio summaries, because nobody likes to see red. Nobody likes to see that, my value was X, it is X minus 10, X minus 20. It's very difficult. Those who live through that, they become long-term investors.
Oh, and in fact, it's quite interesting, because when the market is good, we get those FOMO calls.
Yes.
Like market बढ़ रहा है, कहाँ where do I invest? और जब market थोड़ा correct होता है, we get panic calls. क्या करूँ? Market गिर रहा है. I think this mindset has to change. I think realigning to goal.
देखो, वो change नहीं होगा, वो अच्छी बात है. आप फोन करो, ज्ञान लो, सब कुछ करो, right? But touch नहीं करना है, बस. आप रोज बात करो ना, कोई प्रॉब्लम नहीं है. React मत करो. Gain knowledge, why the markets have gone down, what is the issue, what can happen, how will it improve, when will it improve. Educate yourself, read a lot, get confidence, right? From that perspective, it's good. But don't react.
So in fact, very interesting thing, when I speak with people who are wealthy, okay, and they have a large portfolio, they think in years. Okay, मेरे को 5, 10, 20, 25 साल तक पैसा रखना है. But when you same thing to middle class people, they think in months. There's a huge mindset gap. So how would you relate this? Why do you think this is a mindset gap? And what message do you have for those middle class?
Again, it's to do with insecurity. See, typical middle class investor would have a very limited corpus.
Okay.
There are, you're still struggling to get to the basics, right? You need to achieve quite a lot. You have many goals to achieve. From a lot of perspective, you have not reached the stage of financial freedom. Now, at that stage, obviously, you are slightly cautious. You are always on the watch. You're worried that your money doesn't fall off or you don't lose money. There's always a fear in middle class, right? And that's the big challenge which this community faces, and which is where a lot of knowledge, a lot of content going through all kind of talking to distributors and all of those people to understand and live through. See, the challenge comes only when times are uncertain.
True.
Right? Rest, everything is fine.
True.
So yes, that thought will be there. It is very, very natural. There's nothing wrong in that thought. Even I had that thought 10, 15, 20 years back. But once you get to a basic corpus, and once you get closer to the financial
I don't see my portfolio at all.
Exactly, right? So, but think about yourself 15 years back or 20.
Correct.
Of course, we were scared. Of course, because we had very limited corpus, right? And we have goals. I mean, when you have limited corpus, you're worried about emergency funds. You're worried about if something happens on the medical side. You're worried about how your kids, which schools will they go, right? So there are a lot of worries. So whatever that money you have, you're a little insecure. So that is where all this comes from, that they keep thinking of, typically the average investment horizon or investment duration of a typical middle class would be 2 years or 2.5 years. That's what they see. And compared to the rich people, they have a lot of money. They are more about wealth creation than wealth preservation.
Correct.
So they are in a different mindset. They're in a different zone. So I think the middle class also should just do a very careful thought through financial planning. Put as much money in equities, more specifically in equities, which you can forget for 10, 15 years minimum. Don't overinvest. That will help you come over this behavior of thinking short term.
Fantastic. Yeah, you should actually create a kind of a balanced portfolio in a way where your long-term aspiration is chased by equity.
Yes.
And because to fund your immediate goals or a short-term, medium-term goals, you have enough money that you don't bother I don't get sleepless nights.
Yes, and there are so many good products now. So much innovation is happening. Asset allocation funds, which are a mix of
Correct.
debt, equity, gold, all kind of funds, balance advantage funds. These are very, very good products which will minimize your risk. It will not
and
hurt
yet
your
deliver good
capital, and
return.
yet it has the potential to deliver 3-4% higher than inflation kind of returns.
Absolutely fantastic. Yeah, I completely agree. See, actually, one more thing which we have noticed is a lot of these people. There's a huge fascination for owning real estate.
Yes, yes.
Okay.
Yes.
So I think they are all, when you look at the asset allocation, though, they're all real estate heavy.
Yes. Yes.
So what would you want them to advise? How should they be navigating? Yes, I understand. Any middle class, when I buy a real estate, it is obviously going to be a little bit heavy.
Yeah.
But still, how do you balance it out? Ensure that you not.
So first of all, one has to understand that if you are buying real estate as a home where you're going to stay, is not an investment.
Correct.
It is consumption.
Correct.
So let us not count that into asset allocation.
Correct.
Because you're living in that house. You have consumed. In fact, you're not earning from that asset class, right? So it's not an investment. We have to keep it out. If you're buying a second property which is going to yield you, then it's a different way to
Then you count it as an asset.
probably look at. Now, how would I look at real estate? I would say that certainly I think our value systems in India certainly suggest that everybody should have their own home, right? At some stage, definitely one should target to have their own homes.
Correct.
Right? I wouldn't advise to have 2 homes, 3 homes, 4 homes, but you need to have a good home for yourself at some stage. I would say that one should not hurry up in buying own home because it takes a lot of capital, and you also have to leverage in terms of home loans. So then there is a commitment
EMI.
of paying installments, and then you're paying interest over those installments. So buy a home when you have a reasonable sized corpus. Your income levels are good enough where it will not pinch you paying EMIs. So maybe late 30s, early 40s. That could be a good patch when you can think of getting into a house if you don't have a house, right? Till such time, I think rentals are superb. Rental yields are very low in India. I mean, 1.5%, 2%, 2.5% at best. You can get dream home for peanuts, right? You don't have to spend on maintenance. You don't have to just you just have to spend on utilities, right? And save that money, whatever investment you would have put as seed capital, plus what you would have paid for EMIs, use that capital, invest it wisely, and that capital will ensure that you can buy a home when you are like stress-free.
Correct. You are paying 2% rental yield out here, and you are saving almost minimum 8% EMI cost.
Yes.
That itself will help you to speed up the acquisition at a later stage.
So
you must own a home,
I'm sure,
but don't hurry up.
I'm sure all your audience would know Ramdev Agarwal, right? Who's my boss and who's the owner of Motilal.
Correct.
He's, I think, 70, I think he's 73, 74, I think. He's bought a large home now, like few years back.
Okay.
He just had a 3-bedroom home for all this while, right? And he was staying on rent in the same building. One of the top buildings of Bombay, but he's bought a duplex now, multiple duplexes. But now at this age, right?
Warren Buffett has a simple house.
Warren Buffett has a simple house, right? So don't rush into real estate. Don't stress yourself unnecessarily. Enjoy your life. Focus on earning well, investing well. At the right age, when you are secured, go for it.
No, we get a question out here from a lot of people who are pro real estate, and I'm not saying I'm not negative, but I think it's good to demystify this.
Yes.
They say, okay, I'm investing in real estate.
Yeah.
Okay, I may be getting 2% rental yield, but after some time, the capital appreciation, I get 2% on that mark to market value also. Then it doesn't remain 2% rental yield. Okay, it can be higher.
Yeah.
So what will your advice will be? Should
that will be only possible if you have a lot of money and you're buying a second place as an investment. That's what I said. First is your home, so that doesn't give you anything.
Correct. No, second.
Now, if you're buying a home or a land for capital appreciation, fair enough. I mean, if you feel you're getting a good deal, maybe yes, right? But again, one has to keep in mind the
vis-a-vis equity.
mood difference between equity and real estate is liquidity. See, if I need liquidity, you can sell equity today, tomorrow morning, money is in your account, T plus 1. And regulators are talking about T plus 0 today, same day transfer.
Correct.
Right? Either real estate, what I have seen in real estate is that buying real estate is easy, selling real estate is a hell. Right? So, you have to keep that in mind.
I agree.
Yeah.
Liquidity is a big concern.
Yes.
Taxation, hassle, all those things, transfer, all these are big hassle.
Yeah, and if you want to participate in real estate, you buy into REITs. I mean, such a people will get best, underlying you're getting best properties participation as a shareholder into the REIT. Some of the best properties, good yields, chances of capital appreciation. REITs are there. There are some very good real estate institutionalized funds where underlying the funds are actually investing in great properties, commercial, residential. So indirectly you participate into real estate backed return. Like we say that gold is important.
Correct.
Right? It's important from asset allocation perspective, but buying gold in a financial asset form is advisable than
In the
physical form, right? You don't end up buying jewelry and then thinking that this is an investment, right? So you buy a gold ETF or something and you get gold linked returns. Similarly, you want to participate in real estate, or you want to participate in you want to buy real estate in Bangalore, Delhi, Bombay, wherever. You have a fund which does all of that. Indirectly, you're getting participation through financial assets.
Correct.
So these are good ways of diversifying your portfolio across equities, real estate, credit, fixed income side. So many opportunities are now available in India.
Great question. In fact, you have beautifully touched. Yes, people should start getting more disciplined towards goal planning, financial planning that adds method or a process to performance, like you said, beautifully articulated. So that's the process of doing a financial planning, goal planning, and then investing.
Yes.
And we have also been hearing about asset allocation.
Yes.
Okay, and that's the holy grail of investing. But unfortunately, we feel that there is not much amount of discipline.
Yes.
In while managing investments.
Yeah.
And forget about the retail investor. I have seen a lot of advisors also not being too disciplined in terms of trying to comply with the decided asset allocation.
Yeah.
Because in good times you become greedy, in bad times you become fearful.
Yeah.
So what is your thoughts on asset allocation? What should be your message to those audience?
So the answer is actually in your question. Typically what happens is we are in a habit of chasing the best performing asset class of the recent past, right? So there is a bias called the recency bias. So for example, if you talk about today, there is this huge FOMO about missing out on gold and silver.
Correct.
Over the last 1 year, these two commodities have given 70-80% return.
Correct.
And equity has given zero. Now suddenly the volumes on, we have our own ETFs, right, on gold and silver. Suddenly the volumes are gone through the roof, right? There's like $500-600 million worth of buying which is happening in gold and silver ETFs. Now that was not part of the plan. Let's say a typical investor who would have made some plan that I will have only 10% gold.
They all got overboard.
Now they'll end up owning 20, 30, 40% of gold.
And perhaps at the wrong time.
Yes. And see, the whole thing is that we try to extrapolate whatever has happened in the last 1 year to what can happen in the next 1 year. So if in the last 1 year gold and silver has done well, now there is a firm belief that next 12 months also gold and silver will do well. Or if the last 12 months equities has done well, then next 12 months equities will do well. And that this whole, that fear of missing out and owning more of something which is done very well is where your plan tends to get derailed, right? So it's again, I said, it's quite natural. But these are the times, Tanveer, where the discipline, your behavior, your intelligence quotient, whatever you call it, your perseverance, living through such temptations and sticking to what you have decided, basis goals, that will go very, very long term. And again, either one has to do this within own self, or then you need experts to help you navigate through these short-term temptations and help avoid mistakes of chasing something which has done very, very well in the recent past. So there's no right answer, honestly. One has to work on it. See, look at this, like if somebody has, let's say, blood pressure problem, right? The blood pressure problem is there. Doctor has given you 2 pills to have in the morning, right? And you have to have every morning. Now that having the pill is on the patient. If you're not going to have the pill, you will have volatile blood pressure, right?
Correct, you'll have problem.
So all we can all suggest is that this is what you should do, this is what you should stick to, this is what you should avoid, all of those things. Practicing that is actually then eventually in the hand of the investor, right? We can be coach all along, but one has to listen through.
So in fact, now, see, I like a lot of middle class.
Yes.
And in fact, and affluent also. Earlier it was more with affluent and wealthy, but I think it's now the middle class also aspiring to send their children offshore abroad to study and all.
Yeah.
And their not only the education inflation, but the currency risk which is there also elevates the cost of study.
Correct.
So what would your advice be? Should people be allocating some part of the money to overseas investment? It could be S&P, I know it's run up a lot already, or it could be any other international market or any other product where they are investing in dollar denomination via the LRS route.
Yes. No, certainly I would recommend very strongly to have a reasonable amount of your allocation in dollar format. It could be owning, you can buy simple indices in US like a NASDAQ or a S&P 500. There are a variety of ETFs, and now, like you rightly mentioned, you have the LRS route which is available where every individual can put up to $250,000 every year, right? So you can use that limit to put $5,000, $10,000, $15,000 for a goal which could be maybe education or it could be anything else. I mean, so the first thing you achieve is diversification. So you are diversifying your risk from one country to
another country.
2 countries. You can buy China, you can buy Europe, you can buy emerging market. There are many combinations one can do, and by the end you will probably have world indices also, which can have combinations of different. So that is one level of diversification. I think it will certainly help. And yes, if at all at some stage there is a certain expense you have, which is where you have to invest in dollars or you have to spend in dollars, then like you rightly mentioned, over the last 25-30 years we have seen like 4-5% depreciation of Indian rupee.
Correct.
Maybe next 25 years you may not see 4-5% of depreciation because India is getting very strong now.
Correct.
But still maybe a percent or 2 depreciation over a longer term period is quite possible. So keeping some part in international assets will help you diversify, de-risk single country risk. Second, help you plan better for any goal which you have where you have to spend in dollars in long term.
Very good. So now this LRS, we should do the conventional way, or now the GIFT City opportunity has come, we should go via the GIFT City opportunity?
GIFT City is the best. GIFT City is the best. You have all kind of products now available, and more are going to be launched. Right? You can buy active funds through GIFT City, where good fund managers in offshore locations which are doing better performance than the index. Or if you don't want to do that and you just want basic market returns, you have good beta oriented products also. You can just simply buy a NASDAQ index or a S&P 500 or a Dow Jones or emerging market, whatever it may be, right? So there are many products available in GIFT. I think there are the integrated stockbrokers also. Many broking firms are also now
like
giving
interactive stockbroker.
they can interactive stockbrokers.
Interactive
where you can buy directly into a ETF through that, or you can buy a good company directly, right? Use that limit of $250,000. So if you have the understanding, you can go directly and choose what you want to buy. If not, you have funds available in GIFT City which you can use to invest.
And worst situation, you can go to indices also.
Yes, absolutely.
See, you have beautifully coined process to performance. Okay.
Yes.
And what we have seen when managing with wealthy, a lot of people have their own family office. Okay. And they've created a process, and that process itself delivers performance. But unfortunately, that the same practice is not followed by middle class. And the thought is that you have a limited sum of money and you cannot build a process.
Yeah.
Which I feel may not be true.
Yeah.
you can start building a small amount of money with the process. So do you think this is the right approach of building a process first and then investing, or just trying to invest ad hoc?
See, of course, you need to have a starting point. So you need to have basic processes in place, and then processes also will evolve with your experience. But yes, you need to put some framework before you actually jump into investing and all of those things, right? So getting the process first, start executing, see how it is going, learn from your mistakes, keep tightening the processes. At one stage, you will have the perfect framework, right?
So if you have to demystify this process for a normal layman, from a pure investment perspective, okay, and having him achieve his life aspiration with limited amount of money, what are the processes that he should follow to ensure that he actually gets to his goal?
Yeah, so we've been discussing this. I think the first leg of the process, the first lever of the process for a layman investor or a middle class investor or a retail investor is basically to sit down with a pen and paper and first jot down earnings. How much are you spending? What is left for saving? When that figure comes, so that's the first part you do, the dirty part, right? Then the second part is basically writing down your immediate, medium term, long term goals. Why do you need the money? That asking that question, why, is very, very important. When you put down your 4 or 5 large goals, right? So like we discussed, some goals could be a year away, 5 year, 10 year, 20 year away. So you have identified that, okay, for each goal, adjusted for inflation, how much money would you need, right? So for retirement, let's say you would need, maybe let's say for talking purposes, 1 crore of rupees, right? Today you don't have 1 crore, right? So but you have to put that figure down, right? Because that will give you that alarm bells that, oh my god, I need 1 crore for this, I need 50 lakhs for education, I need 50 lakhs for marriage. You write down. So now what is happening is everything is coming down like a funnel, right? How much money do I have? How much I earn? How much I spend? How much I save? How much I can save? If I have to save, what am I saving for? Short term, medium term, long term. What would be the approximate value of that goal which I have to achieve? Then last comes that, okay, for this goal, this should be the asset allocation. Asset allocation is very simple. This asset allocation word sometimes looks very complicated. It is nothing but there are 3 assets to choose from. There is equities, there is fixed income, there is gold. You have to play between these 3 assets. That's it, right? Now, if you have a very, very long-term goal, you will have higher allocation towards equities. For a very, very short-term goal, you will have probably no allocation to equities. So you put your asset allocation basis different goals. Then the final process is what to buy, which is which product, which fund manager, all of those things, right? So that's like the last part. So these are the frameworks. If one can write, then decide, and keep this as as something on the your desktop, that every time we were discussing that markets go up and down, you are getting tempted, you are getting confused, and go through that drawing board, what you have written, why you need money, how much money you need, what allocation, keep going. So I think those processes. Now I will go slightly off track. Let's say in Motilal Oswal AMC, right? Now Ramdevji has been an investor for 4.5 decades probably, right? And through his journey, the initial journey of 10, 15, 20 years, he started building process of investing. So he used to own 200, 300, 400 stocks. So this is what he says. But that was not the right way of investing, right? So to own few good businesses which could compound for long term, he started building frameworks. He started building processes. And what were those processes? It took 20 years to build those processes, right, which now what we call as QGLP, which is quality, growth, longevity, price. So if you want to buy a good company, it has to be good quality, run by good management, businesses which are growing, longevity growth, and buy at a good price. So these are the 4 frameworks for creating a portfolio of stocks. Similarly, you have to create a framework for creating a great nest egg or corpus for a variety of goals. But putting processes is very, very important, and that's the most difficult thing.
So today, I think there is so much of information available. When we meet with people, at times, people talk as if they are all fund managers.
Yes.
They mean like,
yes.
They have due respect to them. In fact, what I've realized is that, but over a period of time, and spending 30 years in the industry, that humility has taught me
Yes.
it is not the maths, it's the behavior
Yes.
that actually matters more.
Absolutely.
Okay. So how do you, according to you rather, what is more important, that behavior is important or that maths is important?
Behavior. This is investing is all about behavior and how you're going to behave in different times. More specifically, like we said, one part of the behavior we discussed was, are you a reactive person, or are you a proactive person, right? Are you a process-oriented person, are you an ad hoc person, right? So these are all behaviors. Are you a person who gets carried by whatever events are happening on a which is what we call recency bias, right? So these are all the emotions which are or behaviors which typically people have. So and that is what you have to navigate through, right? There is where you have to build processes. There is where you have to modulate your brain, to coach your brain, to then stick to what we say is more emotional quotient than the intelligence quotient. What I've seen in my life, with due respect, is the more intelligent you try to behave in investing, the more poorer will you be. The more bad decisions will you take.
So what weightage would you give discipline out there? Discipline of investing.
So discipline is 99%.
Okay.
Discipline is 99%.
So
see what happens, Tanvir, basics. When do people react? When do people go off track financial planning? When do people forget about their goals? Is only when we go through very volatile times. There is a huge, let's say India-Pakistan war happens. Suddenly we will be scared. There'll be social media, there'll be news, panic, markets will fall down, markets will crash, and everybody forgets what was the bullshit. We just go and exit. When it came to, we all remember COVID, it was just 5 years back, right?
Correct.
We all were confused, we all were nervous, though we were part of the industry, but we never got this thought that Nifty will become zero. I used to do a lot of investor calls, probably you also were doing investor calls, and Nifty was falling like it opened and down 10% down, right? So actually started looking like it's going towards zero, and we are in a situation where the world is shut. There's nothing, there's no economic activity happening. But people started predicting it's zero, just get out. Whatever I'm getting, get out, right?
In fact,
those who lived through that,
they've made money.
They tripled, quadrupled their money. Those who reacted are not able to come back.
Come back, yes. They lost the money.
Yes.
Correct. So, in fact, today there's so much information available. People can actually manage their own money. Okay. But there also, on the other side, there is a role of a coach. Okay. So what would your advice be for people?
So you spoke about maths, right? Maths and something you were talking about. Now, through ChatGPT and artificial intelligence, certainly you can invest on your own. You just write which are the best funds and all that stuff. You'll get the answer. You can just simply invest money, which is good. So that's a maths part. But when it comes to behavior, when it comes to tiding over difficult times, living through volatility, living through uncertainty, that is the time you need a coach. That is the time you need Krishna Bhagwan, who then takes you through maturity, expertise and all that stuff, that how do you navigate through tough times, right? Sarthi. So everybody, I'm in this business, but I have my distributor advisor, right? I don't do direct, right? Except for a couple of funds I've invested in my own fund house. I don't need any advice for that. But yes, for my other stuff, I take help. वो एक कहावत है कि एक जो डॉक्टर होता है वो अपना खुद का इलाज नहीं कर सकता है. एक डॉक्टर को भी अपना इलाज कराने के लिए दूसरे डॉक्टर के पास जाना पड़ता है. So how much ever intelligent you may, even you spoke about family offices or you spoke about super HNIs. Even these people have advisors, multiple advisors.
Correct.
While they are experts, these people who have family offices are all basically entrepreneurs who have created a lot of wealth by building big businesses. So they know everything. Correct. Yet to manage those hundreds and hundreds of crores of portfolio, they have multiple advisors who share ideas, who give them intelligence, give them knowledge. See, this business is all about, investing is all about knowledge. It is all about understanding. understanding of politics, geopolitics, finance, economics, all of those things. The greater the understanding you have, the better investor will you be, right? So everybody needs Sarthi, everybody needs a coach. You go to a gym and you start working out without a coach, you will not get muscles. Right? If you want to swim, you don't know swimming, you cannot jump into the pool and then apne aap hi aa jayega. You need somebody to teach you to swim, right? And then if you have to get better in swimming, then you need a coach all your life to keep making you better, right? So certainly I would say that have a family doctor, have a family financial advisor, have a family coach. I think it helps. It helps.
Fantastic, great. So now coming to you, Akhil, suppose if you were to advise your 25-year-old self on finance and investment, what would that advice be?
So I have this mantra which I've created over time. Is basically invest early, invest regularly, invest for long term. I learned this only after my 30s. So from my 24 till 30, I was doing stupid investing, ad hoc investing, no process, nothing, and I lost a lot of money. Post 30 is where I got into disciplined way of investing into equities, SIP, diversified funds, not withdrawing till I need money, right? So those kind of things. So if I have to go back to my age 25, I would have started to invest prudently at the age of 25 because I lost 5 years of compounding.
Fantastic, good.
Yeah.
In fact, like we all have made mistake. Like you said, in the initial you mistake. I think I also recall my incident when I was just starting a job. I started a job, and it was a stockbroking outfit. I saw everybody trading, got carried away.
Yes.
And I lost a big amount of money.
Yes.
And I had to borrow money to repay that.
Yes. Okay. Which is also important. Actually, in investing, the beauty of starting early is that initially you can afford to take risk.
Correct.
Right, because you have 40 years to work. So the first 5-10 years you can experiment. You try Bitcoin also, I would say, at that age. Right, lose money, then come back, and then you do the basics. But invest.
But asking you, do you invest in Bitcoin?
No.
Okay, great. So what investment mistakes that has taught you more than the good things? I think the biggest learning I got, like I said, early days is that my personal investing, basically leave it to professionals than trying to do on your own self. Okay.
Right. See, typically I'm a business guy. I'm good at doing business. Let me focus on business and not trying to pick stocks and multi-bagger ideas and all of those things. So I learned I don't have any stock except for my own stock. I don't have any other stock. I have only mutual funds. So give money to the best guys for whatever you do. So professional fund managers, and you have plenty of them now. Right. So for a small fee, you can sleep peacefully in the night. Right. So that is what I would say.
So what are your thoughts on...
And to choose professional fund managers, you need to have people like you who become your Sarthi to take you there.
Thank you. So, and what are your thoughts on balancing money act? Okay, so because I think I missed this question, I would ask you. What are your thoughts on balancing money act? Where I'm coming from today, a lot of this generation, you've seen consumer debt had gone through the roof.
Yes.
Consumer debt has gone up. It means that people are borrowing and living. Okay. It is good to enjoy, but when you are not able to save, it jeopardizes the future.
Yes.
But on the other, there could be people who save a lot, but not able to enjoy.
Yeah.
So, what would how should one balance this two?
Yeah, it's a great question. It's a very tough one to answer because see, everything is important. This Buffett says that income minus savings is equal to expenses. I think write down this formula on a piece of paper, right, and then fill in the blanks. So your income minus, first you decide that how much you want to save. Bare minimum 20-30% should go in after taxes, should go on save in your savings, right? When you have done that saving wala part, the rest of the money you buy mobile phone, buy TV, buy fridge, whatever you want to buy, but put that into a chart, right? Get the savings done first. Then whatever is left over, spend.
If a lot of people who are in a debt trap kind of a situation, they're not able to save now because they've taken so much of debt, the EMIs, all those things.
Yeah.
What would your advice be to those people?
Yeah, it's a very personalized thing, what kind of debt but yes, I would say that if you have high cost debt, like you're rolling over your credit card
cards.
outstanding amount at 3% per month, or you have personal loans at 17-18%, these will kill you, right? Because in 5-6 years or 2 or 3 years itself, the interest portion will be equal to principal.
Correct.
So there are, you first thing is to basically get rid of the high cost loans, get into the low interest loans. It could be maybe if you have a home, or if your parents have a home, against that you can take borrowing, cut your interest cost. You will get a little bit longer time to basically dispose of your debt at a lower cost, right? First thing is replacing high cost debt to low cost debt, and then from your earning, I think whatever you have, right, except for your fooding and basic clothing, etc., first cut the debt. It's going to be a long journey, maybe 6 months, maybe 9 months, maybe 12 months. But till such time, if you have done blunders, then you have to pay the price for that, right? So there is no party till the time you're cutting off your debt. And for cutting off the debt also, you need discipline.
Yeah.
So there is where the discipline also comes.
Correct.
Right? And I've been a victim of this in very, very early years of my work also, where, the moment I got into job, suddenly you want to buy a good car, you want to buy a good mobile phone, and, and simply use the credit card as if you don't have to pay for it. Suddenly you realize that I don't have enough money to pay for all of those things, and then the debt starts climbing up, right? So at some stage I also had to do this, where I had to, ensure that credit card, whatever you spend, you have to pay in that month. So spend that much only which you can pay. Right. Correct. So a lot of things, you learn. I mean, you have to do these mistakes, learn from them, and then get better. So no need to get worried. It's a serious thing, but it's not that you cannot handle it. You can handle it. It may take some time, but it will teach you quite a lot. Yeah.
Okay, we both agree that the Indian middle class does not need luck or timing. It is the process. Okay, and that's the process will lead to performance and help them create wealth. So what I have understood that there should be having a clear-cut goals and a map, a financial plan, and a roadmap on how they're going to reach the goal.
Yes.
Okay? And more important is the not only getting that started, but having the discipline of following to that goal, that asset allocation and plan through the market cycle, and be safely at your destination.
Correct.
Thank you so much, Akhil, for sharing your insight.
Thank
it
you.
was really, really helpful,
Thank you.
and I loved it. Thank you so much.
Thank you so much for calling.